Welcome to The Explainer. Today, we're going to break down StarHub's full year 2025 financial results. We'll be looking at this strictly from an investor's point of view, using the info they've put out themselves.
So here's what we've got on tap. First, we'll hit the big headline numbers. Then we're going to dig into the two sides of the business, because they are very different. After that, a quick financial health check. And to wrap it all up, we'll see what the road ahead might look like for them. All right, let's get right into it. Section 1. The big picture. So what's the story for StarHub in 2025? Whoa. Okay, the first number you see just jumps right out at you. We're talking about a nearly 50% drop in the company's profit that goes to shareholders, their take-home pay. Compared to last year, that is a huge drop. Okay, let's put that number into context. If you look at this table, you'll see total revenue was basically flat, not much change there. But look at the NPAT, that stands for net profit attributable to shareholders. It fell off a cliff, going from over 163 million Singapore dollars all the way down to just 82 million. I mean, that's the massive drop we were just talking about. And you can also see their EBITDA here, which kind of gives you a sense of their core operational profit. But here's the twist.
Despite that scary-looking profit number, StarHub came out and said, and I'm quoting here, that their performance met outlook across all key metrics. So they're saying they hit all their targets for the year. So that's the big question, isn't it? How can both of these things be true? How can profit fall so sharply, yet they say they met their goals? Something's going on under the hood here.
Well, the answer really lies in this idea that StarHub is basically two different companies running under one name. It's a real tale of two businesses. So on one side, you've got the consumer business. This is the stuff we all know, right? Mobile plans, your internet, your TV. And that part of the business is really feeling the heat from intense competition. But on the other side, you have their enterprise business, the part that sells to other companies. And that segment, it's on fire. It's become their new growth engine. And you can see this struggle so clearly right here. Look at these numbers for the consumer side. Revenue from mobile and entertainment services, both down by more than 7%. That is not just a little dip. That's a real sign of how tough that market is right now. The price wars are intense. But then you flip the coin, and it's a completely different story. This is the enterprise side. Cybersecurity revenue is up over 4%. Regional services growing by almost 3%. So while one side is shrinking, this side is definitely growing. Okay, so with all that in mind, let's do a little financial health check. A big drop in profit can look really bad, right? But does it mean the company's actually in trouble? Let's take a look.
So first, there's a really important idea we need to talk about: free cash flow, or FCF. Think of it this way. It's like your household budget. It's the cash that's left over after you've paid all your bills and made any necessary big purchases. For a company, it's a super important sign of financial health.
Now, check this out. At first glance, this number is, well, it's alarming. A negative free cash flow of almost $25 million. That means more cash went out the door than came in. That usually sets off some alarm bells.
But hold on. Like with the profit number, there's more to the story. Turns out that negative number was because of a huge one-off payment. We're talking $188 million for something called spectrum rights. That's basically just them buying the rights to use the airwaves for their mobile network. It's a necessary but very chunky expense.
So what happens if we just take that one-off payment out of the equation for a second? Well, the picture completely flips. They would have actually had a positive cash flow of over $163 million. And that's a much healthier number, very much in line with how they've done before.
And that's the key takeaway here. Even with that massive one-time expense, the company's books, their overall balance sheet, still look healthy. Their debt is at a manageable level.
Okay, so what does this all mean for the future? Where is StarHub headed from here? Let's look at the road ahead. Well, they've laid out a pretty clear game plan. Priority 1, work on fixing the consumer business, make their mobile plans more attractive. At the same time, they're going to keep pouring fuel on that enterprise and cybersecurity fire, because that's working. And, of course, they're looking to tighten the belt and find ways to save money across the board. And for investors, this is what it often comes down to, right? The bottom line. The board is proposing a final dividend of 3 cents per share. Add that to what they've already paid, and it brings the total for the year to 6 cents for every share you own. And all this really leaves us with one big question looking forward.
StarHub is clearly in the middle of a major transformation, but can the growth from that shiny new enterprise engine be strong enough to pull the whole company forward while the consumer side is facing so many headwinds? That's really the big challenge they're facing.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.